Hi, everyone, and thank you for joining us today for our webinar, Student Loan Payments, Expectations, and Strategies to Help You Prepare. My name is Kelly Blount, and I'm the Program Marketing Specialist here at General Electric Credit Union. We're so glad you've joined us. We have a great discussion planned for you and wanted to thank you all for tuning in from the comfort of wherever you may be joining us from. And with that, I'd like to turn things over to Todd Moore with Trinity Debt Management to introduce himself and take us through today's topic.
Well, thank you so much, Kelly. Great to be back with everyone today. I'm Todd Moore from Trinity Debt Management and worked with General Electric Credit Union for a number of years now, and proud to partner with the credit union as we work to improve finances for families here in the Cincinnati community. So today we've got a very interesting and timely topic for us to discuss. We're now in the period of student loan repayment. So today wanted to walk you through some of the new provisions, some of the changes in the law, changes to some of the program repayment plans, and really just help you transition back into the repayment structure. As we all know, we've come through a very difficult time the last 3 years with COVID-19. Federal student loan program was paused for a number of years, and we're now heading into October, mid-October, where payments are now set to resume. So today's webinar really is to help answer some questions that you may have about some of the new payment structures that are out there, and really just to help you walk through and navigate this new world of student loan repayment. Just one moment. There we go. So as you know, if you've been following this, and many of us have been affected by student loan issues in the last several years, here we are, we find ourselves in this period of just increased inflation, and all costs, all of our finances really, for most of us, we find ourselves somewhat struggling to keep up financially, adding an additional payment, particularly student loan payments. What we know is that for many of us, we're already stretched due to inflation and the overall costs that we're facing. So what we're finding here through the Department of Education is that while the payment pause is over, and that we know that student loans will be resuming here in October, there's also some provisions to kind of help us through this period and get us back into the student loan process. So as you know, back in 2020, really what we're looking at is just different measures of the Department of Education to suspend payments, stop the collection process, make certain that things were not going into default. And that pause really is, the last 3 years, where now that it's expired, and really want to walk you into where we're at this point, helping families move forward. So in June of 2023, and I pulled this from the Department of Education's website, this is a very significant, for many families, this is going to be significant to add this additional payment. There's 43.6 million individuals out here through the student loan program, 1.64 trillion in student loan debt, and then the average borrower somewhere around $38,000. So we know that these payments may increase financial difficulty. And I know that certainly there's going to be a lot of questions perhaps this afternoon about different program types. We're hoping that at the end of the seminar, we'll be able to provide you some details to help you answer some of your questions, but also be a reliable source both at the credit union and here at Trinity, so that if we don't have the answers, we know how to get those answers for you and help you as you resume your overall payments. So the first thing here that we should consider is that as we move back, you should have gotten some type of notice. Usually it's, I think the regulation requires 21 days. So your servicer should have let you know, hey, payments are set to resume. 21 days from now, we're going to be expecting, that next monthly payment to come. Should you find yourself in a situation financially where you're just worried that you're not able to make that overall obligation, you cannot make your overall payment, there's what's called the 12-month on-ramp repayment period. Okay, so what's significant about this is that you're not considered basically what we're looking at here is a provision so that you don't move into delinquency or default. Whereas prior to the pandemic, where we would not be able to make payments, collections, credit score impact, moving through that delinquency period that, up to 270 days, that can result in, you going into delinquency, where you'd have to go into the Fresh Start program afterwards to kind of rebuild your payment structure. This 12-month repayment, this is kind of what we're calling the on-ramp to kind of get us back into that process. So let me highlight just a couple provisions for you. And again, this is for folks that you find yourself maybe unemployed, you just cannot make their overall payments, you're struggling with payments. What do I do? There is an option here for you. So we would want you to take advantage of this 12-month on-ramp repayment period. So I'll highlight a couple provisions for you. So student loans won't fall into delinquency or default under this program, okay? Whereas they would have prior to COVID-19. Again, transitioning, this is transitional period. This will go up through September 30th of 2024. So student loans won't fall into delinquency or default. Missed payments won't be reported to the credit bureau. Credit scores won't drop as a result of missed payments. And another factor that is a nice provision in this particular repayment period is that it's not reported to a collection agency. There's no garnishments, no withholding of taxes and Social Security benefits, and those sorts of things. So that is a tremendous, tremendous help. Now, it's not a continuation of the interest-free pandemic payment pause. Okay, so go back to what happened before, where there's no interest accumulated during that pandemic pause. The provisions I just laid out, those are all the positives of this program. So the other thing that we have to think about is, what are the potential drawbacks? So interest does continue to accumulate. So that's going to, while you got the 12 months of the on-ramp repayment time, if you need that time, again, interest does go to the back end of the loan, so it will continue. And then missed payments are still due after this period expires. So if you get 12 months through this particular program, keep in mind that that adds an additional 12 months for future repayment. So we're basically just swapping some of these provisions, but look, this is a fantastic opportunity for folks. The real problem here is that prior to these types of changes, you would go into delinquency or default on a student loan if you did not have the financial means or the capacity for repayment. So if you are finding yourself in a situation where you're not able to make payments and you just can't afford it right now for whatever reason, you can take advantage of this on-ramp provision. And again, delinquency and default, those are things, and the impact to a credit score, those are things that you don't have to worry about during this repayment period. So this is a great opportunity for those who may be on the call that are just struggling as payments begin to resume. So a couple other things here too, as we start just thinking about this period of repayment. Again, I mentioned that it's 21 days. Most loan servicers are sending out letters. You may have already gotten one at this point that things will be due for October. A couple things that I want you to be aware of here is just going back and recognizing that there are some ways that we can help you through the credit union. So General Electric Credit Union has what's called the Thrive High Yield Savings Account. The idea here is that as you restructure your finances, that you can have a separate savings account where you're starting to put money into that account to kind of help you through your student loan repayment period. So, if you don't use the on-ramp and you want to, continue to make payments on your student loan, you can afford to do so, but you're going to have to restructure your budget in a way to kind of meet this additional expense and all the other loans or other obligations that you have. You may want to consider just transferring some funds into this savings account, kind of build that fund so that you can use that fund to supplement your overall student loan repayment, as you move forward into 2024. So keep that in mind. If you have questions about the savings account, reach out to the credit union and ask about setting up that account. And again, this would be a supplemental account to kind of help you with your overall student loan repayment. The other thing is that go back and review your budget. We've done a lot of work through the credit union on budgeting. You might want to go back and look at some of the archive budgeting presentations and savings presentations that we've done in the past. But the bottom line is we want to be able to work to cut unnecessary expenses. We just really are trying to look at, this additional expense. It adds to some of the difficulty that many of us are facing financially, just trying to keep up with our overall obligations, whether it's our mortgage, car loans, whatever it might be. Adding this additional expense after 3 years, we know that that comes with a challenge for many families. So we just want to be certain that you do review your finances, go back to budgeting, and factor this expense back in as you meet your repayment obligations. So if you have any questions about that, you can always reach out to us at the credit union, or you can reach out to me here at Trinity Debt Management. Be glad to help you with the budget, kind of restructure your finances to get you back into, overall manage your expenses so you get back into the habit of repayment. Also, want to talk to you about this loan modification through the credit union. Should you find yourself in a situation where you're just experiencing a lot of financial difficulty and you're struggling, to keep up with payments, whether it's a car loan, maybe you have home equity line of credit, maybe your overall mortgage, whatever it may be, we're really hoping to reach out to you, let you know that a loan modification is possible. Now, a couple of provisions here, keep in mind, if you have high credit card balances and other debt obligations, if you find yourself carrying a lot of private student loans where the public provisions are not really, those tools are not working for you, and you have private student loans that you're really struggling to manage, credit union understands that you don't have tools in the private market easily to solve that problem for repayment. You want to reach out to the credit union. Let us know if you're struggling with your overall repayment. We want you to be successful. We want this transition to go smoothly for you, and we want you to be able to keep your loans. We don't want you to go into default. So if you find yourself in a situation, you always want to reach out to the credit union. Let us know if you're having any kind of trouble so that we can maintain those loans, make sure that you're successful, and let us do what we can to either modify that loan or just make certain that we find a remedy for you. So I want to walk us back for just a moment. Let's think, think about our loan servicers for a moment. These are the folks that are responsible for collecting your payments. Well, it's been 3 years. So if you haven't thought about that loan servicer for a while, I wanted to provide some information to you, kind of stepwise as you work your way back into repayment. If you do have questions, and there's been a lot of questions about loan servicers because federal government has changed some of the contracts with some of the large servicers. So there's names that are different than what they were 3 years ago. Contracts were extended to do different servicers. Some were phased out, some are new. If you have any questions about your loan servicer, though, those folks that you make payments to, studentaid.gov is an outstanding reference for you. You'd always want to start with studentaid.gov. And most of the information that we've pulled here for you, it's really, you can go back and see those provisions in detail at studentaid.gov. So you can always go through My Loan Servicers section on studentaid.gov. You can just do that as a search. That'll help you find your servicer. You can also call the Federal Student Aid Information Center. I've given you the 800 number there. With studentaid.gov and the 800 number, if you have any questions with your loan, not only just identifying that loan servicer or questions, you really want to reach out. I know that you will find some servicers are easier to reach than others. Here at the office at Trinity, there's times when I hear folks say that they can't really reach folks on their end. It's very difficult. The reason for that is as they've made contracts with different servicers in the market, some of those servicers are taking on, again, look at the numbers we talked about earlier, millions of people transitioning back into repayment. So those wait times are extremely long right now. They're trying to add staff to address the overall need. But some services are doing a great job at meeting overall demand for questions, and then others are really trying to scale their staff to be able to do a better job of answering your questions. Again, don't hesitate to reach out to your servicer with questions. That's where we want to go. And if you can't get the answers there, we always want to call the Student Aid Information Center to make certain that we're getting those answers. And you can reach out to me if you just need some additional guidance. Just bounce some questions off of me. I will help you find the answer. Here's an example of what I was talking about earlier with all these different changes in the last 3 years. I won't run through this list, but I did want to provide that to you. Some of these servicers, you'll notice some of the big names now, but whether it's Navient transitioning to a new name, I haven't necessarily seen anything through Navient. I actually have Navient myself for my own student loans. I've not seen the new name referenced. I continue to make payments to Navient. They're trying to streamline that process as easily as possible. So the name change probably is coming. You may not have seen that yet, but you can see here a lot of folks with different servicers and how they've transitioned your account to a new servicer. So wanted to provide that to you just for some clarification. Again, you could find this same information if you looked up federal loan servicer updates through the studentaid.gov website. You would also find these updates listed there. But this just gives you some context of the number of changes that have been made just in the market for those who are actually collecting payments, your loan servicer. So now that you've gotten that part, you're back in the process and you're understanding your loan servicer, getting payments set back up. This is where we start getting into what payment structure should I look at? What's best in my best interest? What can I do at this point? So again, 20 days, 21 days, the regs call for a 21-day notice. You'll know beforehand that these payments are set to resume. There is, folks are trying to offer some reduced interest rate. You get a 0.25% interest rate if you can sign up for automatic payments. If you're enrolling auto pay and you want, a 0.25% interest rate reduction, you can do that. If you find yourself again, though, where you're just not able to make those payments as planned, this is where we'd want to start to look at, what can I do to adjust or lower my monthly payment amount and set up a due date that would work for me and with my current employment. So this is the part where we get into those steps about repayment plans. So this is where I'm going to try to walk us through and clarify some of these changes that have taken place in the last 3 years. Now, there have been a number of changes when it comes to repayment plans, okay? So you can see here, standard repayment's always that 10 years. So if you have someone who's new in the student loan, a new graduate, you get a 6-month grace period. So if there's any folks on the call that are just recently graduated and trying to figure this out, you would fall into this standard repayment structure where they're looking at 10 years of repayment. And then you get a 6-month grace period. For the rest of us, we're trying to figure out what can I do to reduce my overall payment? What's the best plan for me as I transition back into the repayment requirements? So you'll see here that income-driven repayment, the federal government, Department of Education is really focused on income-driven repayment. That is really their policy priority at this point. That's really what they're asking folks to do. And this is where you're going to see the most changes in student loan repayment. Now, I'm going to I won't highlight all of these, but you'll see the variations on this theme, income-driven repayment plans. So you've got what's called the SAVE plan, which we're going to talk about. Pay as you earn, that's automatically been transitioned into the SAVE plan. So if you were on a pay as you earn repayment plan, it's now called SAVE. It was replaced by SAVE. Doesn't necessarily mean on your income if there's changes that you're in that program, but they've tried to transition individuals and families into that plan. And then whether you're looking at income-based or income contingent, again, this is all focused on lowering monthly payments and time frames for repayment. You can simplify a lot of this by looking at really just the focus from the United States Department of Education on really income-driven repayment. That's really what folks are trying to do. The on-ramp, the 12-month on-ramp is being pushed, and also the IDR SAVE plan, which I'll get into that here in a minute. So income-driven repayment plans, you can see here, like I said, whether it's income-based, income contingent, these all fall under income-driven repayment types. As a policy priority, however, federal government is really asking folks to look at taking a look at this SAVE plan. Now, let's talk about some of these provisions here, okay? So the SAVE plan just stands for Saving on a Valuable Education Plan. This is the newest IDR plan that they have. One of the big changes here is that IDRs always look at your discretionary income and family size. So when you're thinking about lowering your monthly payment, the provisions are always what is your overall, adjusted gross income, and then family size. Well, under the SAVE plan, this is really looking at, it's really trying to expand the IDR provisions. So here what they've done, where it used to be 125% AGI or gross income, they broadened that to 225% of poverty guidelines adjusted for family size. So, they've really doubled what was available before. And the reason for that is they're wanting folks to be able to have lower payments and the interest benefit, okay? So let's kind of walk our way through this. If you were on that pay as you earn plan, you're automatically going to get the benefits of this new IDR plan, the SAVE plan, okay? So it expands the poverty provision up to 225% and family size. If you're married with a spouse, takes that in consideration differently. So it can really adjust your overall monthly, adjust that payment downward, okay? So it lowers your overall payment. And then the interest benefit there, this also is going to help with your overall interest, accumulation of interest. So it's a true benefit to folks as they transition back into repayment. If you're looking for a plan and you're thinking, I can't do this, what am I supposed to do? I can't afford to do it. This is where I would recommend you start looking at a plan like this. You look at that on-ramp, that's one opportunity for you during the on-ramp. So it's going to automatically help you during that period. The downside of that on-ramp is that you're going to extend out a year of repayment plus the interest on the back of the loan. Here, through the IDR SAVE, if you can afford, this really reduces that payment down. So if you go online to studentaid.gov, there's a table listed where it will show you adjusted family size for the new poverty rates at 225. So you can see where a payment, if you make $60,000, I think they're referencing your payment is somewhere around $220 a month. If you start to, as you go down, through $60,000 and below, there's increments of where that adjusts and how the interest is beneficial, okay? So I really want to encourage you to go to studentaid.gov and just learn more about this overall plan. I know that sounds a little complicated, but if you really want to simplify this plan, what it's doing is it's simplifying how you make payments and adjusting for income and family size. And then you can get the details on income amounts by just looking at studentaid.gov. But the overall plan, again, is to lower those payments and have an interest benefit. Other things that you might want to look at, and this, I would not necessarily recommend this unless you absolutely have to, because I think there's other provisions that are better for you at this point through income-driven repayment. But here we look at, deferment and forbearance options. These are still available to you. Maximum time is 36 months. So you can see here the difference. And it's really deferment or forbearance. It really kind of aims at the same outcome in terms of just lowering overall payment amounts. But depending on the type of loan that you have, whether deferment will reduce interest or it will continue to accrue, it really depends on the type of federal loan that you have. And oftentimes I have to pull, because there's so many variations, I have to pull the information to find out which one would actually fall into that interest category. But the thing that's important about this is that, let's say you're unemployed, should I go into deferment or forbearance, or can I take advantage of the on-ramp? You kind of have to think about those scenarios. I mean, you can use the deferment time, you can use forbearance, maximum 36 months. But again, as a policy priority, what the federal government is pushing right now and trying to get people into is take advantage of the on-ramp for 12 months if you need that time, okay? Because again, keeps you out of delinquency default, and there's not the credit impact as there would have been before. If you go this route, the difference here is that you're using up that 36 months. And at some point you may need that. There may be, think about it in terms of risk. There may be a time when you're sick or something else happens. As you move past this 12-month period, you may need that time for a hardship. If you use it all now, you can't rely on it later. But these are provisions, again, that are intended to lower monthly payment amounts and help you through a difficult situation. Loan consolidation and refinance, a couple things here to keep in mind. For particularly, I brought this into the slides because refinance, that is where we're looking at primarily on the private student loan side. So if you're thinking about a consolidation through private student loans and you want to refinance private student loans, that's a process in itself. Most of us on the call probably know that if you're in the private student loan market, the tools that we're talking about now, the on-ramp, deferment, forbearance, those types of things, IDR plans, income driven, those things do not apply in the private student loan market. So then we wind up looking at refinance options that are credit score dependent. So if we're thinking about a number of loans that we have, really credit capacity is what's going to drive whether or not we get better rates under a refinance option in the private market. Now, loan consolidation itself, when we're thinking about federal loans, if you're on the call and you're thinking about the Public Student Loan Forgiveness Program, which we're going to talk about here in a moment, loan consolidation is very important for that process. And if you haven't consolidated loans, that's where we would want to go through a loan consolidation to actually enter into public student loan forgiveness if you're not currently enrolled in that program. I'll explain to you why that's so important at this point here in a few minutes. But again, refinance primarily focused on the private market, credit score dependent, as you look at trying to find interest rates, probably somewhere around 6% for refinance if you have a higher score. In my own experience, I've found a lot of folks are not qualified at this point because of different credit constraints. They're not able to get a quality interest rate or a lower interest rate to refinance where they're currently at in the current market, just because of overall debt issues. But refinance is an option if the credit score is higher. And then consolidation is important as you move into some of the other loan programs if you want those benefits from public loans, particularly to take advantage of the Public Student Loan Forgiveness Program. Hopefully this is making sense. I know it's a lot of changes in the law and changes in the programs, but continue to ask me those questions at the end. Now, again, as I've referenced, this Public Student Loan Forgiveness Program itself. A lot of changes here, okay? I'm going to start for a moment, just let's go to this slide here, the HEROES Act and this case of Biden, Nebraska. Now, if you've been following this at all, this Higher Education Relief Opportunity Act, HEROES Act, basically HEROES Act actually has its roots go back to 9/11. During 9/11, when the Twin Towers went down, there was provisions in the law that allowed under war or a national emergency for the Department of Education to modify student loans. And this case here involved the Biden administration really trying to eliminate student loans under the Student Loan Forgiveness Program under this HEROES Act, okay? If you follow this case at all, this was basically decided against the Biden administration 6-3. It rejected that argument, basically saying that the Biden administration had overstepped its bounds of executive power. It's a separation of powers argument. We won't get into all those provisions, but whether or not the Secretary of Education had the ability to waive loan forgiveness. This was a lot of money that the federal government was looking to waive. That did not happen, but there's some new things with public student loan forgiveness that are being rolled out at this point that I think you should be aware of. So if you are in, if you're on the call and you're thinking about, how does this student loan forgiveness program work for me at this point? There's what's called the one-time IDR adjustment, one-time income-driven plan adjustment that will count towards public student loan forgiveness. So let's say that you work for a nonprofit, you're in education, military, government, some sort, and you've not been involved in the public student loan forgiveness program. You have until December 31st to enroll now, and the time that you've been paying, okay, it could be 10 years, it could be longer. If you've been paying and you've worked in that sector and for whatever reason were not enrolled in the public student loan forgiveness program, there is what's called a one-time IDR adjustment, okay? So basically what it allows you to do, you'd have to consolidate your loans through the direct loan program. You enroll in the public student loan forgiveness program. I know this is complicated, but you enroll in the public student loan forgiveness program, and it will count any prior time up all those years that you've been paying. You now will get credit for that in the public student loan forgiveness program, okay? So you only have until December 31st to apply for that. And basically, if you've been paying, say 15 years or more, then your loan's going to be automatically forgiven. There's a lot of details on this program, but that one-time IDR adjustment is something that if you're in the nonprofit sector, those prior payments, even if you've not been in a loan forgiveness program before, they will count under the one-time adjustment. So I've listed the Public Student Loan Discharge Ninja. This is on the student aid site. It walks you through those provisions. I'm actually looking at those provisions myself to learn more about them, but it is truly a way for you to take, if you've been in the sector, medical, nonprofit, government, you might be eligible now for loan forgiveness. This particular program sat idle for a number of years. Under prior administration, the public student loan forgiveness program, there was a backlog of almost 3 years of applications. They really sat idle. So a lot of folks did not get any type of forgiveness during those periods. The one-time IDR is really trying to clarify that process and move it forward, but it also is much, much broader. So if you were on an income-driven repayment plan in the past, okay, IBR, income-based, ICR, income contingent, which varies your overall payment amount. If you've been in those programs and not in student loan public forgiveness, you can count all of that time towards this program, okay? So wanted to highlight that to you. It is time bound. You only have until the 31st to apply, so reach out to me if you have additional questions or go to studentaid.gov, but you'd want to start to expedite that process now if you want to receive the benefits under that program. A couple other things that I want you to be aware of when we're thinking about just overall debts and just managing overall repayment. I've had some direct experience here recently under what we call the closed school discharge. Okay, so I've referenced a case here, won't go into a lot of details, but it's called Sweet versus Cardona. This is another law case that made its way through the Ninth Circuit Court of Appeals. This is really looking at predatory lending in the student loan market. So there was a number of schools. There's a very large list of closed schools. I'll put the link in for you, but here in Cincinnati, a number of these schools were listed. Basically, what we're looking at is if you're enrolled in one of the schools that's on the closed schools list, or if your school closed within 180 days after you withdrew from that school, or there was a school closure, that loan could be discharged. So you're no longer legally obligated for repayment, okay? So Sweet versus Cardona had pretty broad reach. If you do some research on the closed schools, you'll see that a number of investors they actually own a number of schools, and many of those schools are right here in Cincinnati. Really in the last month, I've looked at least 3 or 4 different cases where folks have their loans. I did some work for them where they're no longer liable for those loans under the school discharge, closed school discharge. And that's really a result of this predatory lending case, Sweet versus Cardona. So thought that might be interesting if you are thinking about just, looking at all things student loan. Take a look at this closed schools list and see if those provisions may help you. Maybe eliminate that part of your student loan debts as you try to maybe manage other student loans that you acquired, post whatever school you attended through that time in your life. Because many of us, we transition from one school into another. This may be a benefit to you. A couple other changes that are out in the loan market at this point, and as a result of changes, there's been some total and permanent disability changes. I won't get into a lot of these provisions. I just want you to understand that these changes are in place. Prior to these rules, it was really difficult for for a bankruptcy filing to demonstrate total or permanent disability for bankruptcy filing. Now there's what's called the undue hardship through the bankruptcy court. So it's you can challenge student loans at this point through a bankruptcy if you meet total and permanent disability. It was certainly more challenging prior to these rules changes. But I've again at Trinity see a lot of different cases. I've seen folks where this has applied to them as they've eliminated some outstanding student loan debt. And then lastly, the bankruptcy discharge. Again, this is prior to these rules, very difficult to meet those discharge requirements. It now is a process that will allow families to discharge. I'm not saying that this is a broad-based rule. It has narrow provisions, but in worst case scenario, under undue hardship, it can really help a family that may have been obligated and now is just not able to make payment. It can be discharged to bankruptcy. So the last one we'll talk about really is Parent Plus. So this is where, you've obtained a loan, a parent or guardian has obtained a loan to supplement loans for undergraduate or graduate education. So there are some discharge provisions here as well. So you can now use the Public Service Loan Forgiveness Program. If you took out a Parent Plus loan, you can qualify there. If the student withdrew from school closed, all sorts of provisions that are changed. Take a look at these discharge provisions and, on studentaid.gov, see if some of these things are relevant to you. But the big one is, again, if you have a Parent Plus loan and you've been paying on it, say 8 years, or longer, you might want to take a look at putting that under that one-time IDR adjustment through the Public Student Loan Forgiveness Program, because that would count towards the public student loan provision. The Parent Plus loan now can be put under that Public Student Loan Forgiveness Program through the one-time IDR adjustment. So, all right, so we have covered a lot of ground, and I want to open it up to any questions that you have. I've got a couple questions here that I just put in for us as far as just to get the conversation. I won't read those at this point. I'll answer questions that you have, but I'm hoping that we've covered some relevant topics for you today. The main idea here, again, is that there are provisions to help you transition back into repayment. And there are a number of provisions that will work to your benefit, whether it's the on-ramp or through, as I've mentioned, the one-time adjustment or the income-based repayment plans that are there, income-driven repayment plans that are there. Those are the ones that are being pushed right now and suggested as a policy priority to help folks better manage their overall student loan debts. And then lastly, reach out to the credit union, reach out to us if you're having problems. with any of your student loan payments that may put other loans at risk. I want to close real quickly by pointing out a couple of things here on resources for you. There is going to be a webinar. You can go to the Department of Education site or studentaid.gov. There's going to be a webinar that will just be an extension of this conversation. It talks about return to repayment. That's the on-ramp and the new SAVE plan that we talked about. If you are interested in that, that's next week, I believe, on October the 25th. You can sign up for that through Eventbrite. I've given some numbers here to contact your loan servicer, and then also, questions just about direct student loan issues, and maybe even some regulatory guidance if you're interested in that on student loan forgiveness through the Consumer Financial Protection Bureau. So lots of detail here, lots of information, and you can always reach out to me. Like I said, I know how to track the answer for you. Be glad to help you. And I hope that helps you at least understand some of your options. I'll close now, and Kelly, I'll take some questions.
All right. Yeah. Thanks, Todd, for walking us through, the end of the relief period, what we can expect, and how we can prepare for payments beginning this month. So, as Todd mentioned, we'll now open it up for the Q&A portion of today's webinar. As a reminder, if you do think of a question, you can submit that using the questions feature in your attendee panel. There were a few questions pre-submitted as well, so I want to make sure we get to those. So we'll go ahead and start with one of those. The first one being, about 2 weeks ago, I got an amount for my payments, and recently I received a new amount for my payments. I tried to contact the company and failed by both email and phone. What can I do?
Well, again, it's going to be very, very important. We'll want to make sure, number one, that we understand, I'm hoping that you do understand who that servicer is. If you're contacting that servicer and you just can't get through for whatever reason, I believe what's current practice now is that if a servicer has sent out repayment to you and they've let you know that, here's your due date, here's what we're expecting, I think most services are depending on the loan types that you have, I think most servicers, a missed payment, it automatically goes into either deferment or forbearance. So the new policy provisions that are out there through the Department of Education are really intended so that it's not onerous to you. Again, part of those provisions during the on-ramp period that we're talking about all the way until September 2024, that's to make certain that if you have missed a payment, there's not the same credit consequences, there's not the same delinquency attached, those things that I ran through earlier. Those provisions don't apply during this 12-month. So if you've missed a payment, I would think that under the rules, you're probably automatically going to be placed in deferment or forbearance. Now, you're going to have to be diligent, okay? Because as I've said, you can go online and try to obtain your account through studentaid.gov. Use some of the references that I mentioned earlier. Try to set that account up online to find out servicer, find out how we can reestablish that account online. Second part of that is you're just going to have to be diligent and call. It's going to be difficult for some of these servicers because, remember, they're taking millions of people back into the system for repayment. And I know I've talked to so many folks, they can't get through, they don't know what to do. The underlying structure here in terms of this policy is to make certain that you're not penalized. There's not the same credit consequences. There's not delinquency and default provisions attached. So understand that there is somewhat of a safety net at this point for student loan borrowers. And that safety net is really placing you either in deferment or forbearance and keeping you out of some of those dire consequences that would have been there, prior to COVID-19. Long story short, continue to call. Let's try to reset your account. You can give me a call. I'll try to do some investigation for you as well. But by default, most servicers are placing accounts either into really one of three buckets at this point. It's either going to go in, if you qualify through income, some servicers are placing you in what's called the IDR SAVE, which we talked about. Okay, reduces on family size and income. So you're either placed there or you're going to be placed in forbearance or deferment. So that's about as much as I know on that question at this point, but we'd have to do some additional work. But there is a safety net in place.
Thank you. Our next question says, I have previous loans for myself and Parent Plus loans for both of my daughters. Can I consolidate now since our one daughter has graduated and then consolidate again in a couple years when our other daughter has graduated, or is consolidating a one-time thing?
Yes, you can consolidate at any time. You can, yeah, that there's no, it's not necessarily exclusive on that consolidation. You can always bring, if you consolidate loans and you want to further consolidate that second round of loan options, you can. Thinking about Parent Plus, you might want to look at some of those other provisions that I laid out, whether or not the one-time IDR adjustment would be beneficial. I'm not certain if you work in any of those sectors that would benefit under the one-time IDR income-driven repayment structure. If you do, that could, you could take advantage of setting that up for public student loan forgiveness. If you're interested in that program, it would now count towards that program. You have to do that before December 31st, but with consolidation, you can always add that back into a consolidation loan later if you choose to do that. The second round of loans can be put back into that consolidation program.
Our next question says, in regards to private parent loans through Sallie Mae, my daughter got a parent loan for her son. She then lost her job and her husband is working part-time until he can secure better employment. They tell her there aren't any options other than to pay it. Do you have any suggestions?
Yeah, the Parent Plus loan itself, at this point, if you cannot pay it, again, you can take advantage of the on-ramp provision. So that's going to give you a year. So let's just say that right now your budget just cannot adjust. You just don't have the money to pay it. When they say that you have no other choice but to pay it, I mean, unless you would meet disability or some other provision where it could be challenged through a bankruptcy, if that's not the case, then there's no statute of limitations on outstanding student loans. So we are obligated to pay it. However, the question then becomes, what payment structure can I put in place that will allow this loan to be affordable? So we certainly want to be able to take a Parent Plus loan and reduce the overall payment amount. So there, I would suggest, one, contacting your servicer, looking at that on-ramp provision. So that gives you a year, depending on family size and income. You can reduce that payment down. It's going to be based on, adjusted gross income and family size, but it can be significant savings. I mean, if you were paying $400 or plus more, you're probably going to cut that payment in half under the on-ramp period. Also, if that expires a year out, I mean, you've got now until September, you can take advantage of the on-ramp that I talked about, kind of rolling you back into the process. That's one. The second part of that would be that you could restructure that through, if you qualify through the SAVE, the SAVE program that I talked about here in the presentation. So what that would do is that puts you in a payment structure that's more affordable, again, based on income and family size. The idea would be that you don't take the default rate or the standard repayment that's being asked of you now. What we're trying to do is modify that in some form. We know we're obligated, but what do we do to modify that loan in some form that would make it allowable or affordable? So I would say, number one, try to take advantage of the on-ramp that gives you a year to kind of readjust. And during that time frame, you could also look at transitioning that into an affordable option. Off the top of my head, I'm going to say it's probably going to be that SAVE option that's going to be the best for you, because it's going to look at adjusted gross income and family size, and that's going to significantly reduce your overall monthly payment And I'm sure that's most important as we go through this period of inflation and just other obligations. So it's one of those two provisions that's probably going to be the best fit long term for affordability through the Parent Plus.
And it looks like this might be our last question. It's asking, how do I keep up when the interest accruals are outrageous? Would it be in my best interest to consolidate?
Yes, it would be in your best interest to consolidate. And again, we want to look at that saving on a valuable education plan, that the SAVE plan that I've talked about. So I hate to keep bringing us right back to that, but that is where student loan debt really is focused at this point. That is really the policy priority through the Department of Education and through student loan collections right now. So if you're not consolidated, if you don't have loans consolidated, and I'm not certain if you were talking about public or private, that question doesn't tell me necessarily if you're public or private. If you're private, as I mentioned, it's going to be credit score dependent. So if you're at interest rate X, whatever that is right now, and you're trying to lower that, the only way that you could lower that would be through a refinance, depending on your credit capacity, whether or not you could actually get one. I think the best rates right now from my own research, somewhere in the 6% range for refinance on private is about the best I've found. And then if we're looking at all those provisions in the public realm through public student loans, you know, what we're talking about here with that SAVE plan is, again, we're talking adjusted gross income and family size. So what we're looking at is, I'm trying to explain this simply. Basically, what we're talking about is we're hoping to reduce the overall monthly payment. Okay, that's one. And then the second part of that is the interest benefit. Okay, so there's really no way to avoid interest entirely, but it reduces the interest on the back end of the loan so that it's not accumulating as much as it would outside of that provision. I know that's a wordy way of saying it, but if you will go and look at that SAVE program, enroll in that and consolidate through that type of program, that's going to be the biggest bang for your buck in terms of reducing monthly payment amount and looking to have the interest benefit. And then again, depending on the type of loan, and this would be for a further conversation, but are you in one of those sectors for public student loan forgiveness? There's a lot that you could look into that as well through that one-time IDR, or just looking at whether any of those provisions would work for you. There is a remedy. I would say what we'd have to do is just do a little bit more digging on this particular question, but consolidation would be a plus, and then it would be looking at what program would be the best benefit, probably the SAVE program or one of those IDR income-driven repayment plans to reduce both the payment amount and then restructure the interest. So I hope that helps.
And we actually did receive one more question. It says, can the on-ramp program be applied to private student loans?
Unfortunately, it does not apply to private student loans. That's one of the challenges, again, that you run into on the private student loan market is, I talked about in terms of the safety net, that is, whether it's the on-ramp or deferment, forbearance, IDR variations, all those sorts of tools that you use, those all apply primarily to public student loans. Whereas in the private student loan market, you're really looking at refinance options. So long story short, no, it does not. The on-ramp would not apply for private student loan market.
All right. Thank you, Todd. That is going to conclude today's webinar. Thank you all so much for joining us, and have a great rest of your day.